Imagine waking up one morning, grabbing your phone, like always, opening your banking app and, instead of your balance, instead of your salary, instead of your savings, you see a single terrifying message. Account unavailable. No explanation. No access. No warning. Just a silent screen that feels like a punch to your chest. You rush to the bank, but the doors are locked. You call customer support, but the lines are dead. People around you are panicking, whispering, "Did the bank collapse?" It feels impossible, unreal, like something that only happens in movies. But it already happened in the United States, not decades ago, not in some distant financial crisis, but just recently. In 2023, America witnessed one of the fastest and biggest bank collapses in modern history. Three massive banks fell within weeks, wiping out billions of dollars and sending shockwaves across the world. And today, whether anyone wants to admit it or not, the same danger is slowly rising again. Quietly, silently, patiently. The same numbers, the same mistakes, the same pressure building beneath the surface. And the scariest part, very few people see it coming. To understand why the fear is returning, you need to understand what truly caused those banks to collapse in 2023. It wasn't some Hollywood-level fraud. It wasn't criminals hacking the system. It wasn't people defaulting on loans like the 2008 housing crisis. The real killer was something boring, silent, invisible: interest rates. When the U.S. Federal Reserve started raising interest rates at the fastest pace in 40 years, it set off a chain reaction that banks couldn't escape. Banks had invested billions in long-term government bonds, thinking they were safe. But when rates rise, the value of old bonds falls hard. Imagine buying something for $100 and suddenly it's worth $60. That is what happened to banks. On paper, they were losing hundreds of billions of dollars. These losses were hidden under a category called unrealized losses, meaning the banks didn't have to admit the losses unless they sold the bonds. So banks pretended everything was fine, till they suddenly needed cash. When depositors started withdrawing money, the banks had no choice but to sell their bonds at a massive loss. One sale led to another, and the balance sheet collapsed like a house of cards. That's exactly how Silicon Valley Bank fell. One spark, one panic, and the entire structure collapsed within 48 hours. Now fast forward to today, and here's the chilling truth. The exact same problem is happening again. Banks are still holding long-term bonds that have lost enormous value. The U.S. banking system is currently sitting on over $500 billion in unrealized losses, a number so large it almost doesn't feel real. These losses don't appear on the surface. Your banking app doesn't show them. The bank teller won't mention them. They are buried quiet, hidden, waiting. And just like 2023, these losses only become deadly if people start withdrawing their money. One bad headline, one viral tweet, one suspicious movement in the financial markets, and people panic. They withdraw their funds, and suddenly the bank has to sell those underwater assets. And the moment they sell them, the losses become real. And the moment the losses become real, the collapse begins. It's a slow bomb with no sound till it explodes. The situation becomes even more dangerous when you look at where people are keeping their money. In 2023, when panic started, ordinary Americans moved their deposits from small regional banks to giant banks like JP Morgan and Bank of America. People believed big banks were safer, so small banks started bleeding money. Today, the same pattern is forming again. Millions of Americans are shifting their money toward bigger banks, online banks, investment platforms, and even crypto. Small banks, especially regional and community banks, are losing deposits faster than they can replace them. And when deposits leave, the bank has to shrink, sell assets, cut services, or take on expensive loans just to survive. The system becomes fragile. One strong shock, and it breaks. A country cannot have a healthy financial system if only the biggest banks, survive while hundreds of smaller ones quietly drown. Another dangerous factor is that U.S. households are more financially stressed today than they were in 2023. Credit card debt is at an all-time high. Car payments are at record levels. Mortgage rates are some of the highest in decades. When people are broke, they withdraw more often. They take out money for emergencies, bills, rent, groceries. This constant pressure drains banks. A stressed population creates stressed banks, and stressed banks create stressed investors. It's all connected. And once pressure builds up in one corner of the financial system, it spreads everywhere like cracks in glass. Add to this the fear of recession, global tensions, and political instability, and you have a perfect recipe for a financial panic. But here's the twist. Today, as banking danger isn't just about bonds and interest rates. A new threat has emerged: commercial real estate. Across the United States, offices are empty. Remote work changed everything. Buildings that were once worth millions are now half empty and losing value every month. Many of those buildings were bought with loans from small and regional banks. If those loans default, if those buildings lose too much value, if those businesses fail to make payments, the banks holding those loans face huge losses. Some analysts warn that commercial real estate could trigger the next major banking crisis. And guess which banks are most vulnerable? Not the JP Morgans. Not the big boys. It's the smaller banks, the same type that collapsed in 2023. The government is aware of the danger, but they are stuck. If they lower interest rates to help banks, inflation might rise again. If they keep interest rates high, banks will continue suffering massive losses. It's a trap. A lose-lose situation. And in the middle of this trap sits the American banking system, trying to survive while balancing on a thin wire. One wrong step, one bad policy decision, one unexpected shock, and the wire snaps. The Federal Reserve is praying for a soft landing, but the cracks suggest something else entirely. Banks can survive stress. Banks can survive low profits. But banks cannot survive panic. Panic is instant. Panic is contagious. Panic is deadly. So the real question isn't whether banks are weak. The real question is whether fear will return. Because if people believe their bank might collapse, even slightly, they withdraw. And if they withdraw, the bank collapses. It becomes a self-fulfilling prophecy. That's how bank runs work. Fear creates reality. In 2023, fear collapsed banks faster than math did. And today, the fear is rising again. Slowly, patiently, quietly. You can see it in the markets, in the news, in deposit flows, in investor behavior, in government warnings. All the signs are back. So is 2023 coming back. The truth is, the ingredients are already here. The pressure is already here. The losses are already here. The fragility is already here. All that's missing is the spark. And sparks always come. Unexpectedly, violently, silently. America has built a banking system that looks stable on the outside, but is trembling on the inside. And everyone is pretending not to notice. But the numbers don't lie. The trends don't lie. The cracks don't lie. The question is not if. The question is when, and when it happens. It won't just be a repeat of 2023. It could be much, much bigger.